We are live in Nashville. Oh my God, we are live. So today, Options Brew TV comes to you on the road. We're in Nashville, Tennessee at the OIC, and we're going to talk with the Flowmaster. So stay tuned. Hey, Jason can't stop laughing. I get it. So we're in the OIC, and Jason had the pleasure of meeting Mr. Henry Schwartz to my left. Henry's been in the business forever, me, right?
My entire career.
Now at SIBO, I'm not going to say your title. You are. It's really long.
I am the I'm the head of global client engagement.
Head of global client engagement. So perfect. So Jason and I have some questions for you this time. You're on the spot. You're in the middle. We're gonna tee you up here. Okay.
That's fine. It's stump the chump.
Okay, stump the chump. So first of all, Henry, tell the audience a little bit about what you do and what you've done. Because you have a name, Flowmaster. So there's a reason for that.
Yeah. They do call me the Flowmaster. I've been in the business for about 30 years. I started as a market maker, traded for some banks in New York. And then in 2005, I started a company called Trader, which was all about tracking option order flow. So we built a little tool. We sold it to all the big banks, brokers. Basically, I was explaining it was a system to alert traders to option flow with as much quantitative and qualitative information as possible. So if you saw a big aggressive call buyer in Tesla, the system would point it out to you basically, and it became very, very important as we went from 5 markets to where we are now, 16. Sure. And then SIBO bought us in 2020, and I came aboard, and now I'm actually working in the DNA department, which is all of our platforms and data. So we have Trade Alert, we have Liveball, we have MT Options, we have Silex, we have some great data.
Right. So now, is that product a little bit more retail customer facing yet, or is it still more institutional, would you say?
It's a mix. Okay. I would actually say, definitely over the last few years, as retail exploded in the options market, we picked up a lot more retail users. The institutional base has been very solid for basically our entire existence, and that continues to be kind of a core. But we have plenty of retail users, and the flexibility in the system is kind of the key. So, like I said, if you're looking for directional sweep orders, the system can deliver it. If you're focused on unusual option volume, the system can deliver it, but it really depends. In fact, when you sign up, you get a blank slate. So It's not going to send you anything, and the customers get to decide what's important to them. We're always willing to help.
Great. So Jason is the Wizard of Ops, right?
That's it. That's me. Flowmaster, Wizard of Ops.
Flowmaster, the Wizard of Ops.
And then just Lex.
That's right. But Jason, you have a product as well, and I know you and Henry have been talking at the conference about it. I think you have some questions for Henry, around Gamma and those sort of things.
Yeah. So we were talking about like options misconceptions and a lot of retail products that are out there. The point of my product, Volin, was to kind of clear up those misconceptions, actually deliver an accurate product. That's like really the purpose of the data platform. And it is mainly based around dealer positioning and the Greeks of dealer positioning and how it moves the market underlying. So I had a couple questions to ask about it. The first is about that typical gamma exposure assumption, where a lot of products out there give you gamma exposure, assuming that all puts are bought by customers and all calls are sold. It's an assumption that was kind of made in a white paper by Squeeze Metrics like 6-7 years ago. And despite the fact that options have exploded in popularity, and even spreads and all kinds of different trade types have, that assumption still is prevalent in the marketplace. And I just kind of wanted to know your opinion on it.
It's a good question, and that assumption. Options markets, options pricing. We have to deal with a lot of assumptions, right? We have from day one, 50 years ago, right? It's the 50th anniversary of options, of listed options, and of Black-Scholes, and there's basic assumptions there, right? And everybody kind of knows, like, well, you know what? We know volatility is not really constant, and we kind of account for it. And with options flow analysis, which is what you're talking about, the buying and the selling, that basic assumption, like, okay, customers buy puts and sell calls, it's probably never been great, but it made some sense, 25 years ago when people hedged and overwrote, right? When that was kind of the flow, and and professionals kind of took advantage of the fact that there was this consistent dominating force. But as markets have evolved, and obviously it's very timely with the explosion of zero-day trading, which is also a really recent phenomenon. I mean, literally in the last year, this has kind of exploded in popularity, and those assumptions don't really hold. We see, at SIBO, SPX was kind of the first product to have zero-day. We trade about 1.5 million same-day contracts every day. And we've spent a lot of time trying to make sure people understand they're not really zero-day contracts. They're listed a month out, but most of the activity does take place on the final day of trading. But you have to be really, really careful when you look at the volume versus the position, and that's when what we were talking about, and I'm excited to kind of hear how you're approaching it, because there's a lot of bad information out there. You can look at the volume and say, wow, 90,000 of these contracts traded. And because there are zero-day options, there's no open interest to go off. So you really don't know what the positioning is. And so you have to do some work to really say, okay, well, out of this 90,000 contracts, what is really being what's the residual of the liquidity community is likely to be hedged. And that's how it works.
Yeah, so I think, Jason, you mentioned this to me. I think Henry's answer is you have a mid-market, you have a bid and an offer in a mid-market, right? It's everything in between. So as things shade toward offers, are you assigning a certain behavior to that type of order, and is the trade shading toward the bid? So is it likely the market is applying that? In the other example, selling something over midpoint toward the offer? And is there a scientific way to assign that at all, other than a good educated guess?
I honestly, all you can do is make the best kind of quantitative educated guess you can, because we've I've done this for a long time, and if you look at a trade, you can go, well, okay, I can see the bid offer was 1 to 110 and it traded at 110. Then I'm gonna determine that as a buy. And that's called the quote rule. It's been used for I think it was used in a quant paper about 20 years ago for stocks. But then there's all sorts of exceptions, and with especially with options, you have complex orders, you have spreads, you have verticals and butterflies, and you have a lot of mid-market prints, right? And so that's kind of where the nuance comes in. You need to understand the market structure. You need to understand behaviors. And when we were talking, and you were explaining your method, especially I like the way you're accounting for offers that split the market and then get lifted, because in a simple quote rule, if the market's 1 to 110 and somebody offers at 105 and it sits there for a few seconds and then it gets bought, it would be an offer side trade. You'd be like, oh, that was a buyer. But you're like, no, that was actually a seller that came to the market. Yeah. And that's where the creativity comes into kind of building, your models.
Yeah. And you account for that, right?
Yep.
So obviously you do too. Right? But you can have your data, though, being at SIBO, you're the source, I'd say. You can see who's on the other side, right? You have the ability to say, oh, that was a Goldman institutional print versus.
We have some ability to see, but I'll tell you the way that the flow comes into the exchange, we can see the clearing firm, and this is private information anyway, it's not disseminated to the public. The only information that the exchange really knows is the clearing firm.
Okay.
So, and that, and the truth is there's 2 clearing firms that handle most of the business in the entire industry. So it doesn't actually tell you a ton. We do have the ability to see kind of which side was the market maker. So, but then that goes into one of our data products, called the open close file, where we actually do sell the analysis that shows in a time interval kind of mode what the customers are doing. But you have to put a little work into it to kind of form it into the analytics you actually want to use.
Okay, got it. Good enough.
You were talking about zero DTE options before, and like really we should call it daily expiration options, because zero DTE even before Monday, Tuesday, Wednesday, Thursday, Friday weekly expiration always exploded in value and volume when Fridays were zero DTE. but which I guess is why you guys offer it. It's saw the popularity. But there was a recent article where J.P. Morgan said that only 5% of options traded in the zero data expiration was retail. And you get to see the trends at part of CBOE. Is that true, or is it mostly institutions, or does retail have a greater share?
So we read that study, and they had some bad information. We know kind of definitively that retail's a much bigger part of the zero-day trading, particularly in SPX, closer to like 30 or 40%. And so there is institutional, there is pro-tail, right? There's retail that basically might be kind of off-floor market makers who are doing their own thing. And that kind of mix of what's interesting, there's no firm activity. So like in SPX, because it's a big institutional contract, right? It is the go-to product for hedging. In the longer dated terms, one of the data points that you can get is, this is at OCC, is how much of the volume is customer firm and market maker. And that's public, and it's published for every underlying for every day. In the longer dated terms, it's about 30% firm in SPX, right? Because big giant portfolio managers need to do a trade, and the bank helps facilitate the trade or wants to take a piece of the trade. When you look at the zero day, there's no firm activity.
Really?
It's all customers versus market makers. It's actually also more market maker to market maker trading, which is interesting because you kind of in the olden days, market makers are all kind of on the same page. Like we don't really want to trade with each other because we're kind of, that's not a good sign. We're both professionals doing nothing but option valuation. So we would expect we end up around the same price.
Sure.
And with the zero day, it's such a new product. And I was talking to somebody at the risk management conference, quant, and I was like, do the regular option models even work for these zero day options? He's like, probably not. This whole concept of like fitting the volatility curve, it really starts to break down into the final couple of hours. It works pretty well in a 1 month option or even a 2 week option. And so that's another really interesting factor. It's all new territory. There's very little academic research. It's just starting to come out. Some of it has some issues, I think, but it's a wide open.
I do some speaking around the country on this stuff, this gamma stuff, and the dealer hedging. And that's the question I get a lot. If you, as a market maker, had to make markets in these zero DTEs, is that a desirable task? I'm like, no.
Yeah.
The pros probably don't like it as much. The retail people love it, right? Totally different set of workflows for each division, right? We're very delta neutral in the pro world. We have to manage our gamma and all our deltas, so that's moving a lot on that last day. That's the point of maybe this model doesn't fit the curve. So I know the pros don't like to be like, heads I win, tails I lose kind of thing. So I would feel that pros would be like, I'm gonna make some wider markets, but it doesn't seem like that. They're still making pretty good markets in those zero DTEs. And I think the retail's just so not that.
Yeah, I mean, I see even in my data when you're talking about market maker to market maker, they probably are transferring risk because by midday, I'm seeing like a very smooth curve. Whether it's both like kind of on the same side in Vanna and Charm or opposite sides, it gets very smooth as the day goes on. I'm thinking like, how is this? How is it so uniform as the day goes on? And I think they're probably really just managing the risk and cooperating in order to manage the risk.
Well, that's a really good point, and I absolutely agree. When you listed these things as an ex-market maker, I was like, what a disaster! Because I'd be the guy that was short, like 800 contracts, and they're a couple dollars out of the money, and then the market would swing right through my strike, and I'd be panicking to try to hedge, and then it would swing right back, and I'd just be like, what am I doing? But one thing that's funny is I've asked liquidity providers. I actually think that kind of in the current world, the liquidity providers are actually very comfortable with these products. And one of the reasons is because the people that I've talked to said they specialize. They have a team that trades the zero-day book.
That's it.
Period. That's it. They don't mix it with their longer-dated risk.
Yeah.
And I think they do spend a lot of time. You're right. The you have to manage your gamma. But I do think that they're like, okay, listen, we need to trade this structure to get out of this concentrated piece very actively. So because you're going to be comfortable with a little bit of positioning, but not something that you're worried about being unhedgeable. The other thing that's really interesting is typically you're hedging futures all day, right? Except that in these 0-day SPX, which expire to cash at 4 o'clock, the futures hedge all of a sudden doesn't work. At that moment, the futures hedge all of a sudden is no good for you.
Right.
So, I think that seeing the liquidity that is there tells me that that those market makers have figured out how to handle this product.
Yep.
And that they're also like, I really believe there's enough flow, really, because it's not. Sometimes I get asked like, oh, this is like the meme stock craze of 2020. Customers are just piling in and they don't know what they're doing. I'm like, they're not all doing the same thing.
Right.
There are condor sellers that are doing it very methodically and repeating the strategy. And then there's option buyers that are also out. So I actually think the reason that there's so much sustained activity in there is that you have kind of a two-sided use case basically. And that's kind of the problem I have with some of these academic papers. They come out and they assume, okay, let's see how the customers are doing with this product. And I can tell you, if we're seeing 1.5 million contracts a day in SPX alone, and there's also 0 days in SPY and futures options, and some of the other indexes too, to see that amount of volume and to know that it's, like I said, a significant part of that is retail and it's consistent, means that it's working. Some people are meeting their objectives. Basically, some people are making money, or they're using it to adjust risk, and they're happy with that experience.
Yeah, that's good. Let me ask Henry a question on some numbers real quick. We talked about retail percentages. I think the industry average for options contracts is around 44 million a day-ish, some give or take. What percent of that is retail? Do you know? Is there?
So I did.
Someone asked me that the other day.
So you can compile that data looking at the 606 filings, which we do, and I have a chart in one of my decks where we basically track the biggest firms that report the 606 data, which does report option contracts traded.
Okay.
So you can see exactly how many contracts Schwab traded or Fidelity traded in the 606 one. And you basically, they release it on a quarterly basis. There's a lag to it. But during the peak of kind of 2020, 2021, those firms all together were doing about 50% of the volume. That's back when the outdated volume was around 30 million.
Okay.
So 15 million contracts a day in the retail, true retail. It's come down. It's around 9 million contracts a day now.
Okay.
Or at least as of December, which is when the last report came out.
So was that about a quarter-ish?
About a quarter.
Yeah.
So, which kind of makes sense because, you figure, you have institutional, kind of making up the difference, and then it adds up to 200% basically because you're looking at how much flow is customer, how much flow is institutional, and then firm and market makers. So basically, customer buying from market makers is two contracts.
And the market maker inventory is some gigantic number of that volume. I mean, they're on the other side.
Almost all of it.
Yeah,
I mean, it's
maybe an institution.
The firm, the firms are positioning around, let's say 10% of the inventory.
Okay.
So the biggest liquidity shops are really kind of warehousing and managing the risk on 80% of the overall.
I guess 90, right? Or close enough, right? You have another question for Henry?
Well, we're talking about market makers and having delta neutral, as Lex was saying. There is, I guess you could say, a belief out there that market makers are out to get people and they have like a delta bias. Is that even possible? Do you agree? Because obviously we don't agree. But cowboys can't exist, really, can they? Like, otherwise, the structure falls apart.
I mean, there is so much activity, right? 45 million contracts a day. We're talking about 5 million trades a day, right? So, market makers are making money, probabilistically, right? They don't need to make money on every trade. But when you have 45 million contracts trading a day, there's a lot of opportunity. In terms of this whole kind of gaming it or what we see, especially in small customer trades, is the tightest realized spread that we've ever seen, right? Meaning, even if the market screen is a little bit wide, okay, you know, the customers are receiving price improvement so much of the time that even on a wide quote, they're getting filled very close to the theoretical value. The concept of, you know, market makers kind of pushing the market around based on positions. I mean, there's a lot of dynamics going on at the same time. A lot of the market making shops that I know actually do very little hedging because they've actually analyzed the cost of hedging and found that they're more profitable if they just avoid it. So, because there's a cost to, you know, that slippage when you hedge adds up. And so, I think that in a lot of cases, the market makers are warehousing this risk and kind of trusting that, you know, that the law of large numbers is going to work in their favor, and that they're going to basically realize that edge. In the end, there's still a path to realize this statistical edge, which we were doing, you know, years and years ago.
Yeah. Okay. Good. You had another one, right, Jason?
Yeah, sure, of course.
We had
I think I can sit there and talk about this stuff all the time.
Oh, I know.
So we've seen several sources claim that same day zero DTE option trades are there's a crash risk associated with them because of a lack of intraday margin requirements by broker dealers, clearinghouses, etc. Is that true? And if so, is there some kind of patch for it?
Yeah, I mean, I've seen the headlines like, "Oh, zero D is going to cost the next Bombageddon," and the gamma bombs, and you know, there's a lot of SIBA wouldn't let me use it, but I created a cloud, a tag cloud, using all the scary words that I'd seen in the analysis, and I showed it to somebody like, "That's funny," and I used like a scary font. They're like, "That's funny, but don't put it anywhere." So it's interesting, right? Because it's such a new frontier.
Yep.
You hear about a lot of, oh no, this is actually vol dampening because people are selling these near the money contracts, so market makers are actually long those, so they actually have less positive gamma. But they're short these. You know, the market makers are short these further outs, and if we get to those further out strikes where there's this concentrated open position, they're going to have to hedge with negative gamma, that the market's going to get really volatile. We don't see it. Like, these positions are really not getting that big. You know, like I said, we use a couple different methods to kind of offset so we can see what the market makers are really wearing. The concept of intraday, our positions kind of getting put on that the clearing firms aren't aware of. You know, people basically taking advantage of, like, I can get away with this for a few hours because they're not going to notice because it's not, the day hasn't ended. I don't actually think that's. I think nowadays there is real-time risk control, basically everywhere, and you know, maybe there's a few dinosaur firms that you know are just not up to speed in terms of keeping an eye on their clients. But I don't think that those would be contributing enough size to kind of create any real market risk. And it was mentioned yesterday in the panel that, you know, there may be some kind of operational risk, but in terms of true market risk, that it's not a big deal. Yeah. And I mean, the other thing that's interesting with SPX specifically is as a cash settled index product, you know, at the end of the day, even if there's losses, they're just kind of cash losses, and then then that position is cleared. And unlike, you know, that some of the physically settled 0-day trades where you actually have to take delivery of stock. Yep. And that's where it starts to get, I think, a little bit hairy. Is, you know, somebody buys a call for $1 in a physically settled product, and if that product runs up, and they've made money on their call, so they're happy. But if it expires and now they have to buy the underlying, they don't have enough money to do that. Yeah. That's the whole problem. That's the challenge with physically exercising, physically, you know, trading. So that's, you know, that, and so those kind of contracts, they have to be unwound before the close, and then somebody's crossing the spread twice.
Yep. Yeah. Okay. I think we have time for one more. Let me ask Henry one thing. You got another two?
Oh yeah, I got one last one, but
hold on.
Okay.
So I was asked, I think you're going to be the best one to answer this. I was asked a question a while back. What's going to be the next innovation in our industry, okay, that pushes volume to the next level? Or maybe there isn't one. Maybe we don't get to the next level. What I mean by the next level, you know, we're at 45 million contracts today. Do we get to 60? someday. And what's going to cause that? Is there some new product that's lurking out there? Some new concept that we're missing? More education of the investing public? Or maybe
I mean, it's a great question. I mean, on the peak days, we've been close to 70 million contracts.
Yeah.
So the market we can handle 100 million contract day, without any kind of issues in the market.
Yep.
In terms of what would get us there, I mean, short-term options help. It seems to me that it's brought in a whole new user base, a whole new use case. So it's almost like without changing the regular listed options, we've created a whole new batch. In terms of what might kind of get us to the next level, I think as things, we're now in this world where we're approaching infinite strikes, infinite expirations, right? Trade whatever you want. And there's flex options, which technically let you do that, but they're not heavily used. Flexes make up less than 1% of the daily volume. Okay. But technically you can trade, an Apple option expires on your birthday with a strike of 162 spot 37. And so, I want to see us get to the point where you trade whatever you want. You don't have to go look at a bunch of listed option prices and pick one of those. So
a custom strike panel for yourself?
Get away from the concept of okay, you need to select the option that's best for you from this prefab list.
Yep.
And
interesting.
Because we see it, stocks move and then they have to fill in strikes, and then there's no expiration on this date, but there will be in 2 weeks.
Yep.
That can all go away. We're at the point where you should be able to basically see kind of available trading prices for anything that you can basically just say, yeah, I want this one, or I want to buy that one and sell that one. The other thing I think that I hope we get to is the ability to do cross-product spreads a little bit easier.
Yeah.
So if you say, I want to get long Apple and short Tesla, and I want to do it in a spread rather than going and legging it.
Sure.
I think we should get there.
Great. You have one more. We're time for one more, Jason.
One more.
Okay.
In your estimation, how much equity liquidity, is driven by option dealer hedging?
Well, it's interesting. Last year, the option volume was up about 5%, and the equity volume was down about 12%. So I would guess maybe a third of the stock volume is coming from the options. So
that's
a
lot.
That's a lot.
We track the ratio of open interest to underlying activity, in notional terms.
Right.
And on average, it's around 10%, right? So it's only 10% of stock volume is traded in the options world, but there are products where it's 30 or 40%. And in some cases, it can get over 100%, which is interesting. Part of that is because if you have a lot of spreads trading, you're double counting the notional.
Yep.
But it seems like I think there's more liquidity in the options market world than there is in the stock world, just because of kind of the size of the firms that are running.
Okay, well, good. Great show, Henry. Thanks for coming on with us. We appreciate it. Next week, we'll be back at our home state. So thanks to Henry and the OIC for having us, and we will see you next week.